Here's what happens when you invest $10,000 in the 3 best Fidelity index funds. $10,000 split 3 ways, left alone for 30 years. That's the whole experiment we're running today. Most people assume index fund investing has to be complicated, that you need a dozen tickers, some kind of secret rebalancing formula, a guy in a suit telling you what to buy. You might think that's what it takes to build real wealth in the market. The reality is very different. 3 funds. That's it. And by the end of this video, you'll know exactly what those 3 funds are, how they overlap, how to split your money between them, and what that money could realistically turn into over 5, 10, 20, and 30 years. So let's start with the definition, because index fund gets thrown around a lot, and not always accurately. An index fund isn't a stock pick. It's not someone's opinion about what's going to win. It's a fund that simply owns every company in a given market, or a giant slice of it, in proportion to size, and charges you almost nothing to do it. No manager trying to be clever. No guessing. Just the market at cost. That's the whole appeal. And once you understand that, you start to see why 3 well-chosen funds can cover more ground than most people's 12-stock diversified portfolio ever will. Before we get into the funds themselves, hit like and subscribe if this kind of breakdown is useful to you. It genuinely helps me keep making more of them. Now here's how the 3 funds break down. Fund number 1 is FXAIX, the Fidelity 500 Index Fund. This one tracks the S&P 500, the 500 largest publicly traded companies in the US. Apple, Microsoft, the household names, plus hundreds of others you've probably never heard of but interact with every day. The expense ratio is 0.015%. Translate that into real numbers. On $10,000, that's $1.50 a year. Not $1.50 a month, a year. That's what it costs you to own a slice of 500 of the most successful companies in the country. Fund number 2 is FSKAX, the Fidelity Total Market Index Fund. Here's where it gets interesting, because this fund owns over 3,600 US stocks, not just the big 500, but the mid-size and smaller companies too. Same rock bottom expense ratio, 0.015%. Now, here's the thing people miss. FXAIX and FSKAX overlap enormously. The 500 companies in the S&P make up roughly 80 to 85% of the total US stock market by value. So if you own both funds, you're not really doubling your diversification. You're mostly just adding a thin layer of smaller companies on top of the same core. That's not a flaw. It's actually useful because it means you can lean toward whichever one fits your preference, more concentrated in giants or slightly broader without dramatically changing your risk. Fund number 3 is FTIHX, the Fidelity Total International Index Fund. This is the one most beginners skip, and it's arguably the most important for actually being diversified. It holds more than 5,000 companies outside the US, across Europe, Asia, emerging markets, all of it. The expense ratio ticks up slightly to 0.06%. Still astonishingly cheap. But it exists because international markets cost a bit more to track. Here's why skipping this fund is a mistake people don't realize they're making. The US is roughly 60% of global stock market value. If you only own US funds, you're voluntarily leaving 40% of the world's investable companies off the table. It might seem like the US always wins, since that's been true for a long stretch. It's a logical assumption based on recent history, but markets move in long cycles, and there have been decades where international stocks outperformed the US by a wide margin. FTIHX is your insurance against betting everything on one country's turn at the top. So how do you actually split $10,000 across these 3? A common approach, not a rule, just a reasonable starting framework, looks something like this. Since FXAIX and FSKAX overlap so heavily, many people simply pick one of the two rather than holding both, then pair it with international exposure. Say you put $6,000 into FSKAX for broad US exposure and $4,000 into FTIHX for the rest of the world. That's a 60-40 US to international split, which roughly mirrors how the global market is actually weighted. If you'd rather lean more concentrated in large US companies, you could do $6,000 in FXAIX and $4,000 in FTIHX instead. There's no single correct ratio. Some investors go 70-30, others go 80-20 toward the US, others split it evenly. What matters more than the exact number is that you own both a domestic and an international sleeve, so you're not accidentally betting your entire future on one region. Now let's talk about what that money could actually become. And I want to be upfront that these are projections based on long-run historical averages, not promises. The US stock market has historically returned somewhere around 10% annually before inflation over long stretches, though any single decade can look very different from that average, sometimes wildly so. International markets have their own separate history, sometimes higher, sometimes lower, sometimes flat for a decade. With that caveat firmly in place, if your blended portfolio averaged something like 8% a year, a conservative blend accounting for the international sleeve, $10,000 would grow to roughly $14,700 after 5 years, about $21,600 after 10 years, close to $46,600 after 20 years, and around $100,000 after 30 years. Assuming no further contributions at all. Add even modest ongoing contributions on top of that starting $10,000, and the trajectory shifts dramatically, because compounding doesn't show up early. It hides. The first decade often looks unremarkable. The third decade is where the curve stops looking like a line and starts looking like a hockey stick. Now, some people like to say index investing is boring, that you're leaving money on the table by not picking individual winners. To be fair, some individual investors do beat the index, but the data on this is stark. The vast majority of professional fund managers with research teams and full-time jobs dedicated to stock picking fail to beat a simple low-cost index fund over any given 10 to 15 year period. That's not a knock on effort, it's a reflection of how efficiently priced markets already are, and how much fees and trading costs quietly erode returns over time. Boring, in this case, is the point. So where does that leave you? With a portfolio that's actually simpler than it sounds. Broad ownership of the US market, broad ownership of the world outside it, rock bottom costs, and time doing the work you'd otherwise pay someone else to do badly. But knowing which 3 funds to buy is only half the picture. The other half is what you do once the money's actually in the account. Because a lot of people set this up perfectly and then sabotage it 6 months later. They panic during a normal dip and sell. They chase whatever's hot that quarter and drift away from this simple structure. Or they never actually automate it, so investing every month quietly turns into investing every few months whenever they remember. And here's the thing, you don't actually need $10,000 sitting around to start any of this. That number was just useful for showing the math clearly. Plenty of people watching this don't have a lump sum, they have whatever's left over after rent, and that's a completely different starting point. So you might like to watch the video I made breaking down a claim you've probably seen before, that investing just $25 a week into a Fidelity index fund can eventually replace your paycheck entirely. I run the actual math on that one, And it's not quite as simple as the thumbnail makes it look. The real story isn't about the $25. It's about what discipline and time do to a small habit once you stop thinking about it as $25 and start thinking about it as a system you never turn off. Go watch that one next, because understanding why the habit matters more than the starting number is what makes everything in this video actually work over the long run.